if you had $50,000 to invest right now, right? And you said, okay, what do I do? Do I buy a bond that's going to give me 12% interest, or do I go ahead and buy a Bitcoin and change, right? Over 20 years, if current trends stay whatever it is, likely that, Bitcoin is going to do better, right? Over 2 years, the bond might do better. You never know, right? It's one of those weird things that you just really have no idea. But it's about what you seek, right? The Bitcoin could be worth a lot less tomorrow than what this yield will give you in about, in 1 year's time almost, right? So it's about certainty, right? It's about certainty. It's about collateral. Like, collateral is a very important thing for me.
Hello everyone, it's me again, the Metaverse Explorer. Welcome back to Grape Solana Alpha. We have another interview with you this time. This time we're talking to one of the core contributors, VNS210, or Vishal from the Superbonds team. They're launching some pretty good products here, so we're going to find out more about them. Thank you very much for watching on YouTube. What you're looking at right now on the left-hand side, we have the Superbonds team on stage at the Grape Discord. On the right-hand side, we're looking at the Superbonds website and their DevNet that they've just released yesterday. So we're going to have a big chat about that. You can look at their Twitter here, and you can look at their documentation as well, which we have up. They have a white paper. If you've got any questions, post them down in the comment section below. For everyone that is here in the Discord, there is the live questions chat. So feel free to ask any questions you have of these guys. So Vishal, thank you very much for joining us. How are you going?
Good, very well, thank you, and thanks for having
me. Yeah, pleasure. I guess we'll jump right in, Vishal. So you guys you've recently released your DevNet, but before we actually get to all the products and what you guys are releasing, I want to talk about you yourself. Can you give us a small brief introduction to yourself? Who are you? What's your crypto story?
Yeah, sure, why not? So my inglorious background, I would say, is I spent about a decade on Wall Street trading emerging markets, global macro, all that fun stuff. Though I kind of came across this space at some point in 2014, didn't really fall down the hole till about mid-2016.
Nice.
I started looking at it very much from the background I had, which was derivatives, right? And risk-adjusted returns, et cetera, so forth. It was part and parcel to this whole macro narrative that we have going on, loss in fiat, et cetera. We were seeing it in the markets for a very long time. And so the release valve for me naturally was to kind of look at this space. I started writing about it quite extensively at times. I mean, you'll see some articles out there like when SegWit 2x happened and the fork and the ARBs and the opportunities, really always looking at, because there's a lot more free money back in the day, I would say. So I took that in stride. I went on to head up principal investments and trading for a new firm that we set up called Elwood Asset Management. It was a kind of a derivative of Brevan Howard, which is one of the largest macro hedge funds in the world, or was at the time.
Yep.
And I did that for some time. I shifted to basically start up a Bitcoin options fund. Options were just taken off, and that was my bread and butter. I knew it very well from the old days. Had a lot of fun doing it, and did it for some time. And then about 2019, I got a little burned out, and I said, okay, I'm going to take some time off. And just when I was kind of, going to put my head down on the pillow, I got a knock on the door from one of the large VCs in the space that said, hey, do you want to build something in derivatives? I really didn't know what it would be.
They approached you.
Yeah, this is quite novel. So I was quite grateful for the vote of confidence. I said, well, thank you. And they said, we'll incubate it, we'll do it. I'd known them for some time, but, informally. But I wasn't kind of expecting that. And that was quite nice. But we launched a centralized derivatives exchange. The way it differed from a lot of the existing stuff out there, it wasn't a fork of, say, MX or even FTX or anything of that sort. We could have done that quite easily, but instead we built it from scratch, modeling it after the CME, which is a onshore U.S. exchange. It has this unique feature called implied order books. And the idea there was to kind of cater to institutional traders. That's what we were built for. And our nomenclature, the contracts, the wording, etc. Basically, the fairy dust in all of this was that, hey, we can price 2 contracts, but we could show liquidity in 3, right? And there was a story behind why we wanted to do that. And so we did that for some time, and it was only when things were kind of starting to pack up on that end. When I say pack up, we hit some naturally we hit some headwinds that weren't a function of regs. It was regs capital. That was it basically. A centralized exchange, unless you have a big amount of cash, naturally you will find it difficult to kind of fight or pay towards the regs all the time and get the right licensing blessings, even if they don't really apply, et cetera, so forth. So ultimately we ended up selling the IP for it, right? Which was quite nice. But our vision carried on, and we said, look, why did we choose to build this exchange? We chose to build it because we wanted to build out the fixed income market in this space, right? Now, fixed income or interest rates in this space are a really, really weird thing, right? And I say that because there's a lot of arbitrary aspects to it. So back in the day, we had Bitfinex basically kind of measure, hey, what's funding supposed to be like, right? And then when BitMEX kind of introduced the perp, they basically said, hey, we'll take the, we'll call this 1 basis points every 8 hours or 3 basis points a day. And that kind of forged itself into this 10% annualized yield. And then all the lending desks kind of set up and were like, oh yeah, 8 at 10, 4 at 12, whatever it was, right? And everything that became an offsuit was a derivative of this, arbitrary 10% anchor that you kind of had initially, right? Of course, after a while, you started seeing, it's supposed to represent what we call the cost of cash, kind of crystallized around that. But it was interesting how it was kind of started. To me, it was a little confusing at times because what it meant is that we didn't have long-term interest rates, right? And so we said, well, hold on a second, because I'll give you a case in point. When we were trading options, say back in the day, you could trade a 1-year option on Deribit, but you could only trade a 9-month future. And I'm like, well, hold on a second. I'm not, the underlying hedge for anybody that trades options isn't the same. It doesn't really work, right? So we said there's something wrong with this. And this is why we pursued that centralized exchange, because what we did was we introduced spread markets. And when you say, hey, you can trade between a 3-month and a 6-month spread or a 6-month and a 9-month spread, and you do it by actually tapping the liquidity in those individual futures and creating that, you start adding liquidity to those futures because everybody just trades on the front end, right? Still today, most of the volume in all the derivatives markets is happening either in the perp or maybe the first future, right? That's it. Nobody goes out the curve. So this was an idea to build out the curve. Now, why do you want to build out the curve? This has a lot to do with why we are where we are right now, right? The reason you build out the curve is because you want to basically, once you establish the interest rate curve, hey, what's the fair value 3, 6, 9 months, 12 months, further down, whatever it is, you start the ability to issue 0 coupon bonds, right? Yeah. That was key. And that for us is instrumental because now the market, now you had something to work with, right? Like in TradFi, we call you could call it whatever, the 0 coupon curve, LIBOR curve, whatever you want to do, right? There's various curves out there. Crypto doesn't have a single curve. How the hell can we talk about, exotic options and all this kind of stuff? They're mispriced. Of course, they're going to be mispriced because there's no way to trade what we call the interest rate risk on it, right? And so that got us very excited. And so while we were kind of fighting the reg headwinds for some time, we said, hey, could this work in DeFi, right? Because look, the market had already shown us through, basically the summer of 2020 that, DeFi is the thing and it's here to stay. And, various sort of lending borrow protocols, people fell in love with APYs, no matter how big of a misnomer they were, all kinds of things, right? Well, exactly. So, and people were showing they're happy to self-custody and jump through some ridiculous hoops to earn yield, right? And when I say, I started farming quite a bit and then I was like, well, this is quite complex at times. You can really lose your money if you might send it to the wrong chain sometimes, right? You don't know what it's very easy to make a mistake no matter how seasoned you were because sometimes the UI and UX would be bad, right? And you wouldn't know. Things would get stuck in a bridge for a while, even, as late as last few months. So we said, okay, look, can we do this on DeFi? And we said we need a performant blockchain to do this, right? Our application has to sit on a highly performant, very fast and reliable blockchain, right?
You're on the right place. Jeez.
Well, yeah, look, for us, ETH wasn't going to cut it at the time, right? I mean, it was the most common place to kind of revert to build anything in terms of DApps, right? And we're like, you know what, the lack of real-time nature wouldn't really help. And so when Solana ecosystem started kind of going, we started testing out on it. We're like, this is cool. This kind of works, right? Like this is as close to real time as you can get. And hence this is going to become a trader's blockchain where trading applications, financial applications will be ultimately better served because of the speed of things, right? Like everybody says, hey, you have this trilemma. Yeah, we get it, right? But we choose to work with this because it made the most sense, right? Of the existing options at the time. And so we started building on it. And long story short, we went from idea to POC to crap, we have a real product here, right? And it was beautiful. And we'll come to exactly why we think that particular product held a lot of clout and promise for the long run.
And when you say we, sorry to interrupt you there, when you say we, who is we? Who's your team behind you?
Yeah, of course. So the other two, so we're a team of 11 now, right? So we're growing very quickly here, 7 engineers, across Solidity, Rust, backend, front end, infra, whatever. But when we talk about the core team, the other person, the other 2 key members for us, the co-founders, we've got Brian. Brian is basically, he's got an AI background, but basically ran a validator on all the chains in like 17, became a Solidity guy, a very strong Solidity guy. And then on Rust, when we started looking at, the Solana, it's kind of like a polyglot, if you want to think about it that way. He's our CTO. He's been the architect of the whole thing. And it's a very intricate build, and then we'll come to why when we go through the product flow. But yeah, he's like the tech anchor for us and for all things. And then Morley, and he's basically, he was with me at our previous place. The brainchild of how to implement a lot of the logic and so forth, and how to kind of work around edge case scenarios. His background is also technical, very strong technical background from one of the highly reputed universities, but then became an interest rates trader on CME. So naturally, you could see how the things started to gel, and then I found BitMax and all that sort of stuff, and we worked together closely on the last product. And I knew that this product would just it would be easy to kind of like convey the concept despite its complexity and break it down into its simplicities to kind of put it out to the audiences. Mm-hmm. So the 3 of us really got together, put our heads together, iterated quite a bit, and said, this is something that we should think about bringing to the market. That's how I would kind of describe our team.
That's awesome. You seem to have a very big engineer and development background, which is super difficult now to have, because everyone's trying to build on Solana. They're always hiring. They don't have enough people to build, but you guys seem to have set yourself up very, very well. You got 11 people, and 7 of them are engineers or developers. That's really good, I think.
Yeah, and then look, what we learned very quickly is that we don't compromise. I have this mantra: I pay for the best. We pay for the best. That's it. We shoot for the best, with the best that we can get, because we're not looking to create a subpar product. And you'll see when you start playing around with the DevNet as to why it's doing the stuff it's doing in the back end to kind of do what it's supposed to do. We think is quite cool. If I rewind a little bit, right, to, when we came out, with this, we got ready with this product more or less in early beta, right? Just kind of like wireframes and stuff in about June or July of 21, right? And we said, okay, look, we need funds to get this thing going, right? Who are we going to get us? Who are we going to get behind us for this, right? And the first place we went to was probably one of the, he's not a crypto native investor, but is basically carrying all the clout in the world when it comes to fixed income and bond trading in traditional market space. And we're talking about the who's who that are anchoring that fund and that are running that fund. And so we had a bit of a collaboration, and we ended up leading the round, and that got some crypto native guys got very excited. You'll see the names out there as to who else is involved in it. But with 4 key investors, we basically closed out an oversubscribed round very quickly to create this product in its full simplicity.
And is that information public at the moment, or it's still not public?
No, it's public. It's public. It's on our white paper as well. You can do, you can look them up. You can see who's who, why, and what's going on. It's out there. It's already out there.
Awesome. Okay. And this is like Commonwealth, LVNA Capital, Polychain, and Genesis Block.
Exactly. And we saw each of them as strategic with respect to how they would complement what we needed to make sure that we had the right impact. And to date, we have no qualms.
Excellent. Strategic partners rather than like marketing partners where you pay them a bunch of money and then they don't do much for you. Awesome. Strategic partnership is the best, I think.
Yeah. So that turned out quite well for us. And so if I may, what was this thing, right? So I spoke quite a bit about, hey, we did this to build this. It's intricate. What the hell does it do, right? So here's how we thought about the problem statement, right? Because we weren't trying to just brute force something in, or nor were we, copy pasting something from like ETH or anything of that sort. Ew. This had to be different, right? And so we basically said, look, yield in this space, as we kind of touched upon earlier, is quite skewed, the concept of yield, right? So how do we kind of address this? Well, how do you generate a fixed yield, right? Well, if you want to generate a fixed yield right now, you have a few options. You go to one of the big lending desks and say, here's my money. Take my money and I'll come back and you'll give it back to me, I hope, at some point with some amount of interest. Fine. You're taking on, onboarding risk, company risk, regs risk, all that kind of stuff. You go to a centralized exchange, you deposit coins, sell the feature, do the same thing, right? Okay, fine. You don't self-custody that though, right? You don't control that capital. It's capital inefficient for you because you're generating interest, but the capital is kind of stuck there, right? Or you could go in DeFi and you go ahead and you farm away whatever you want to do, right? Well, if you do that, even if you're in stables, what's happening is at the end of the day, your yield is undetermined up to a certain point in time. It's highly variable, right? Mm-hmm. Yep. Like, it'll be 15, it'll be 1,000% today, but we all know that doesn't ever kind of work out, right? It lasts for seconds. But it's denominated in a third-party token. Because of that, the value of what you own, the terminal value, is unpredictable, or with a certain amount of significance, statistical significance, as a result of which it can't really serve as collateral, right? Let's take a simple example, right? Say you have $1 million of ETH and you go to a well-known lending platform. You're like, hey, I want to borrow some dollars. I've got $1 million of ETH here. Okay, deposit your ETH. We'll give you 40% in dollars. So we'll give you 400 grand. We're like, what the heck? Only 40% LTV? Oh yeah, that's what we do. And then what happens? Oh yeah, by the way, we'll mark to market the value of your ETH. So if it sells off, like, hey, look at the charts the last couple of days, you better start sweating it because we might liquidate you, right? Or something will happen, right? So you have this like Damocles sword hanging over you the whole time. It's like, what the hell is all this about, right? Where's the real lend? Where's the real borrow? So we said, well, hold on a second. Why can't we have a fixed interest rate outcome so that we do away with a lot of this sort of stuff, right? And how would it work? How does it kind of got to look, right? So it's got to look like the following, right? I want to come to this platform. So let's take a few inflated examples just to kind of show how the numbers work, right? So assume we have a 30-day bond you can buy, 12% annualized yield, right? I think that's fairly common, or slightly, generous than common at the moment. You go in and you said, okay, fine. Here's 99 grand. Roughly speaking, 99 grand. Okay. At the end of the month, I'm due 100 grand. Fine. You deposit in 99K. The smart contract takes the capital, issues a financial NFT. That NFT says, here, look, here's what you have, right? You own this thing. This is what you paid. This was the date. This is the timestamp. This is what it's worth right now if you wanted to redeem it early. This is its terminal value. Its terminal value will hit in 30 days, but it'll be there for 5 years, 10 years. It'll be there for longer than you are until somebody claims it, right? But the point is that you have it, right? But that NFT is now in your possession. And anybody can see that, right? So anybody can say, oh, look, you've actually got something that's worth 100 grand, right? It doesn't move around in value. So I can lend you a lot more than 40% against that, right? I can lend you whatever you want. It's as good as cash, right? And so the question becomes, well, who uses this thing, right? So when we say 12%, I'm sure some people balk and like, well, who the hell wants to do this, right? Well, look, there's two audiences for this, right? The way we saw this initially. The first, as you may imagine, and you naturally start thinking of, is like, hey, this is where people that just don't get yield, that are new to the space, that may want to use this. Yeah, that's true, right? It's a bit of a hand-holding in the DeFi. When you go on the DevNet, you'll see that our UI is quite simple. We're making it even simpler to make sure we don't actually lose any of that audience, right? But the second are these aficionados that may actually think that themselves. Look, I farm all kinds of stuff, right? I generate all kinds of, yield and various things and all that kind of stuff. Well, at the end of the day, I still have some cash in my wallet, right? My unhosted wallet, right? Doesn't it behoove me to actually just take out a bond if it's as good as cash, right? Like what? My redeeming time is a few seconds, right? And my yield is guaranteed in stables. Like, I could have a $2 million farming portfolio. And if I've got 200 grand in cash, I'll put 100 grand in. Why not? It's the same thing as having the cash. What if I don't deploy it? I might as well earn something on it, right?
It's liquid, and at least you can redeem it whenever you want, right?
Exactly. It's the same analog. Like, hey, if interest rates were 10%, would you put what amount of the cash in your mattress would you actually put in a bank and take out a debit card to use it when you need, right? Like, you're going to do something, right? And that something in the law of large numbers in aggregate tells us it's a hell of a lot, right? So that's where we got really excited, because we say, look, the audience for this product to buy a fixed rate outcome is very, very big, right? And so we said, okay, fine. And so this was designed with that in mind, right? And we designed it, and it works exactly as that. So when you go on the DevNet right now, you can kind of do all those operations, right? Well, the natural question that comes up, the first natural question that comes up was, well, who's giving the yield? Where's it coming from, right? Like, who's providing this yield, right? Well, the simple answer is LPs. Now, our LP pool is a little different in this case, right? Imagine I put 10 grand into this LP pool and you came along and you bought this bond. Okay, well, I've lost $1,000. 9 other people come in. Well, my LP pool participants are always losing their money because they're always underwriting the interest. Why the hell would you want to do it, right? Well, here's why. The LPs are made whole over 3 different revenue streams, which are in aggregate in material excess over the fixed yield that they're kind of underwriting, right? So we'll start with the 2 obvious ones, right? The 2 obvious ones, because the industry tells us it works, right? The first one is our own native token, the SB token, which we can talk about in a bit, right?
Later.
Yeah. So you get that as part of the emissions, as part of the rewards. The second is the fees, right? So as people move in and out, so you try to discourage people moving in and out of LP pools as much as you can, because you want to retain predictable liquidity, much like a curve or anything of that sort, where the fees are kind of retained for the benefit of those LP providers. That this happens more or less for us as well, right? So there's 2 key streams, like fees and SB rewards, that are kind of accruing to the LP. The third one is where we had to do all the fairy dust, and where we think we really differentiate from existing protocols. And I really haven't seen this anywhere else, right? It works as follows. So imagine you go ahead and you provide that 99K, right? And the system says, great, and now I got to carve out that 1K from the LP pool. I've got to, get this 100K over to this guy when he redeems it. Okay, great. However, I got potentially 30 days. I'm capital inefficient if I hold this capital here, right? Can I deploy this capital to generate a yield? That was the key question. And the answer was yes, right? But then the question is, can I do it in a transparent way where I'm not going out there and selling puts and calls off chain, or doing, or taking out the top side in some sort of coin that I own or whatever it is, like in covered call
or something like, yeah.
No speculative bets, right? And it's not like you want to generate $1 yield if you own Sol. What's the point of that, right? Like, don't you? If you're gonna own those, like any of these ecosystem tokens, right, that aren't pegged to the dollar, well, the real value return on that is when they do a 5, 10, 20x. Why are you going to sell puts and calls on that? It doesn't really make sense. But can you do this, by generating stable yield? So we said yes, right? We said there is sufficient stable coin yield across the DApp universe to underwrite this, right? How do we access it, right? So first we said, well, we have to define where can you go to get this yield, right? And that's a subject of, that's a matter of kind of doing a little bit of investigations and figuring out, what is quote unquote safe. Now, mind you, this is a governance, parameter, which will be multi-sig back to the community, and they could change it, et cetera, so forth. So initially we define a universe. Okay, here are all the stables that you can change to, and here are all the DApps that you can go to across the universe based on some safety rating that they're given. That doesn't mean that they're rug free, right? That they're
just the rating. Yeah, of course.
It's just the rating. Exactly. So then what we say is that, okay, now that I know where can I go, where may I go? That's a different question altogether, right? So the system has an advanced risk framework. Now it evaluates and says, okay, I've got 99 grand to invest. Where am I going to take this baby? Okay, I can go to this DApp because I want to maximize my yield for a given amount of TVL. And this is on the safe list, so I can go to this DApp. Okay, and how much am I going to send in here? Well, I can't send more than X amount of my capital into here, basically to mitigate rug risk. Okay, I can send X amount of my capital here. But wait, hold on a second. If I send X amount, say it was 10% of my capital, we'll just make up a number right now. Say I had, $10 million, right? And I could only send, 10%. So I can only send $1 million to this protocol, to this DApp.
Yeah.
Well, yeah, if I become, if I deposit that $1 million, what percentage of that pool do I become? Is that more than a certain percentage? If it is, then you can't put even $1 million. You have to do less than that, right?
So you've got some parameters in place to stop them from, like, at least help it diversify, kind of.
That's exactly it, right? And it's programmatic, and it's on-chain, and there's full visibility, right? That's the beauty of it. And further, it's cross-chain. So we're actually entering the Wormhole hackathon. We're very excited about it because Wormhole is actually a big use case for us, and we built with it. And for those unfamiliar with it, it's a bridge, right? And it's one of the better bridges because it doesn't just connect EVM chains. So a lot of bridges will come out there. I'm not going to take names, but you'll look at them and you'll see, oh wow, they connect so many protocols. Yeah, they're all EVM chains. So it's very easy to do, right?
I want to clarify before you go on there. So I want to clarify that you'll be specifically using Solana dApps first for the stable pool liquidity provision, and then you'll be using Wormhole, or your first step is to go through Wormhole?
It evaluates it all in totality, right? Okay. So it'll say, how much Solana risk do I have? How much Ethereum risk do I have? What is the TVL? What is the yield? What do I need to achieve in terms of the capital at base that I have? Because if we look at Solana right now, the ecosystem, right? How much can you actually deposit, and where do you hit problems of scale, right? That's where ETH comes into play. But naturally, ETH fees are higher as well. So when we send off things programmatically, now you have to be concerned about what is the churn that you're going to have in terms of people pulling in and out, right? Yep. So again, the system evaluates on a fees adjusted basis as well that, hey, we can't be pulling money in and out of ETH a lot because we'll just, we'll eat up a lot of it.
Fees will just kill you. Right? Yeah, it won't be efficient. It won't be viable.
Exactly. So we say, okay, so that can't work. So it actually evaluates everything in totality, which is the cool thing, right? But what this does basically is that as a result of which we're able to get stablecoin yield from cross-chain universe, right? Bring it back to Solana and give that stable yield to those LPs. So now the LPs have three yields, right? One, basically they're being made whole on is this, yield in stables. They have the SB yield. And on top of it, they're getting the fees. That in totality is not, 5% higher, 10% higher, whatever it is. It is a multiple.
Yeah, a lot greater than the 13% bond.
Exactly. And so I know somebody's going to ask, well, if that's the case, why don't I just contribute to the LP? And it comes back to that same question. Think a little bit deeper, right? The answer is think a little bit, because you're serving a different purpose here, right? The LP's purpose is very different from the bond buyer's purpose. If you're a DeFi aficionado and you farmed anything and everything everywhere, right? You want a fixed deal. It diversifies you, right? Or you may want it for whatever purpose it is, right? Whereas the LP contributor is looking for a higher yield. And the beauty of it is they can tap the cross-chain higher yield without actually having to go cross-chain because our system does it for them. Right. That's the beauty of it. And that's basically what we're marrying there. The LPs are getting this variable yield, and the bond buyers are getting this fixed yield, but via this, this NFT, if we use the Q word, it's really just a bond, a single mint, right? That they're getting for that. And that's really our V1 product, right? And how it kind of works. And, you play around in the DevNet, you'll see this thing is live. It's basically just getting ready for the bounty and the audit that's coming up in the next couple of weeks.
Yeah.
But you'll see how it's going to work.
I have the DevNet live on right now, and we're looking at the liquidity pools like that you can add and remove to the 30-day pool. And all of this works, by the way. If anyone's interested, I'll put the link down in the description there. This is the trade tab, the liquidity tab, and then there's a stake tab, which means we should probably talk about the token. So I understand the kind of route of what the tokens do and what the stable coins do. They go out to the cryptoverse, earn the yield on their stable pools, and then it comes back. Why do we need your token? What's the utility?
Yeah. So.
Oh no, you've gone quiet, man.
Can you hear me?
Yes, I can.
Okay, sorry about that. Yeah, so the SB token or Super B token is basically another layer of deflationary gas, right? So the mint is fixed, whatever it is, but it's a gas token. Without the token, you actually can't use the platform. You can't buy a bond, you can't sell a bond, you can't check the value of a bond, you can't transfer a bond. The last part we didn't speak about, but the point is that you can transfer this stuff to other people, right?
Oh no, you lost. You went.
Yeah, I'm here. Back. I'm here. Can you hear me? Okay, sorry. Sorry, connectivity issues. But basically, the token itself is the lifeblood of the ecosystem, because you can't actually do a single transaction without that token. It's not as if it gets you a discount or anything. No. Without it, nothing is actually possible. So the system will halt unless it's used in every single transaction.
And is that
that's
how
the way
you guys programmed it to be? Like that's an intentional...
Yes.
Okay, I see. And to clarify, this is on top of the normal Solana fees, because you'll still need to pay your Solana transaction fees, your token account generation. This is to make sure that this is like an extra fee on top.
Exactly. And the way we digested that, right, is like, hey, do people just want to pay fees on top of fees? Well, look, when we actually look at what the dollar fees are in Solana, they're de minimis, right? When you actually look at what the value of the token is right now with respect to what the fees paid are, that is also de minimis. And through governance, the fee structure can be changed. So it's as if, like, if the token rises in value, then, it can be reduced. It doesn't really make a difference in terms of what the initial set of fees are.
Lost you.
So we leave it completely modular. Yeah.
Okay. Yeah. Sounds good. Talk to us more about the token. So how did your TGE go? What's the vesting periods? And I have it on the screen here, but anything specific about the token?
Yeah, so look, the token has a very small float out there. The TGE was fine. There's a 10 billion total amount that can ever come out. Now, I don't get put off by that, because the vast majority of that 6 billion is going to be issued over a very long time. Wine, like, kind of becoming vintage type of emissions curve, right? Again, can be changed through governance. But the market cap is tiny. So we launched on, we didn't do any IEDOs or IEOs or anything. We just think that's disingenuous, really, with like the real community. So we launched on MEXC and we launched on Radium. Both order books, you'll see us in there. You can just type it us in. You'll see it SB USDT. It's trading, I think, roughly, there's 550 million in circulation. Most of those are held by the the market maker who's providing the liquidity. So there's really not much out there. And as a result of which, it's like a $7 or $8 million total market cap. It's tiny, right? We think, over the time, and our main net is due to launch in about 6 weeks, and it should come out with a pretty high TVL in terms of, or we call it TBA, total bonds available. In terms of notional, that will be something sizable, and market should wake up very quickly as to that mismatch. You'll see it in the docs as well. You could go through our Gitbook, you access it right through the docs on our website, and you'll see a lot of this information. But the token, the TG went fine. We have 4 key strategic investors, as you saw. They're kind of mentioned in the white paper. They get unlocked a certain amount, but this is not going to be, hey, a VC is dumping on me type of scenario. These were kind of handpicked guys, and it doesn't really make a difference.
Strategic investors. They're not like a value, like a kind of get an early dump and then move on to the thing. They're there to help you actually grow the business.
Exactly, and we're in constant contact with them, on a regular basis as to, how do we take this thing to the next stage. So even though the first unlocks happened, I think in about month and a half, 2 months time or something like that, none of that is really going to hit the market. And if anything, I think we expect, given the yields that will be there initially on our platform at launch,
that should give it enough drive to even get people to use the token.
More. Exactly. Yeah. So we're quite confident that the offset is going to be quite large, and that there's not going to need to be a large amount of offset in either instance. So that's basically the token and the way it's kind of working and the allocations.
So there's something that I did discuss with you before, and it's about the token as well. So we can see it on SolScan at the moment, and I linked it in the channel there. So you guys did kind of initially launch on MEXEX, I don't know how to say their name. And we can also see your token on SolScan. There's currently only 76 holders of this token. And this is a very large disparity, because your Discord members are about 38,000 and your Twitter followers are 45,000. So what can you give us an explanation of what's happening there? Why are there so many small holders of your token, even though it's live on the Solana blockchain? Why is this disparity so big?
Yeah, no, of course. And that's a very fair question. So basically, what we did is we've hired two marketing agencies to kind of start this out for us. I mean, look, we're not a known quantity, right? If we actually had 40,000 holders of tokens, we wouldn't be at an $8 million market cap now, would we? Right. So what's happened here is we've hired two marketing agencies, and we're trying to basically bring in people from crypto, not bots, real people into our socials that are basically going to echo, serve as an echo chamber for what Super B is and what Super Bonds is, etc. These guys, some of them may not actually buy the token, or maybe wait until they kind of see how it kind of hashes out. A lot of them, I suspect, are probably there just for whatever rewards we may give out. Now, amongst that crowd, though, there are a lot of genuine interest in terms of people wanting to commit capital to actually, play into this. I mean, we look at it overnight, right? The SB token is up like 40%, while the
like
whole
69 I saw last.
Yeah, so everything else is bleeding, and this thing, like I think ETH just hit a low, and this thing's kind of holding in well. It's because those genuine people are now getting the message, right? Now it's starting to echo. Now the conversations originally, we just started our marketing 4 days ago. We're about, hey, great project. They're there for the freebies. I mean, I'm just being transparent, right? Mm-hmm. But now the conversation's changing slightly. Oh, look at this token. It's doing well. Oh, I tried to, get involved in here with Solana down at this point. The conversation is turning more natural, more native to what you would expect from eventual token holders. I expect that number to rise. The other place where you may think the disparity is bigger than what it actually is that, MEXC, or, originally known as MXC, we, as a part of the listing, we gave a lot of tokens to their holders, to their community that were staking their token at MXC or whatever it was. Thousands upon thousands of people got a certain airdrop. Now, because it's in a single wallet on a centralized exchange, it won't come up as a different token holder.
So
that 76. It counts as one wallet, right? So who are the actual unique holders is difficult to say, because the centralized exchange kind of obfuscates that, the complete visibility into it. Based on the responses and questions, and based on the original price action as well, where a lot of people sold their freebies, and I think they're out of the market now. You could, you would sense that, a lot of that stuff is diluted, and the unique holders are actually, much, much higher. Obviously we want to increase it manyfold from here. And I just look at it from a value proposition. For me, it's like, you pick the comparable, you tell us what we're closest to, the market knows, right? The market sees. We put our product in front of you, test it, play with it, break it if you can. We'd be very glad if you did, because we can fix it, right? And we can evolve from it. But
and
we're bloody cheap.
One thing I do see myself is that the market that you're kind of going after is not the retail guy. They don't really understand bonds. They're not likely to buy this token. What I see your general market to be is the institutional investors who understand the value of bonds, or the more savvy, financial literate people in crypto. And those people are likely to be buying this, I think, rather than the retail person.
Yeah, and look, if that's how it starts off, then it may be the case. We hope that isn't the case, and if that is, then what we will do to respond to it, and we've spoken about this, is because we don't want to miss that audience, right?
Oh, yeah, you got to dumb it down for the people. You'll have nicer UI, you'll market it to them and make it a lot easier. Graphics, all this stuff.
Yeah, exactly. So we're on top of it. We're monitoring, we're monitoring all that information and data as it's coming in terms of engagement, visitors, who's playing with the DevNet, how many people, what regions, et cetera, so forth. And we're looking at it, and we're quite confident as to how this kind of shakes out.
We lost you there for a second.
Yeah, so what you see as the UI UX right now is going to change, by the time the mainnet is out there. So hopefully that will speak to a lot more people naturally. That's definitely the intent. But yeah.
Okay, yeah, sounds good. It's just like Solana, and I interview a couple of teams, and it's ship fast, try to break it, fix it afterwards, it becomes stronger after you break it. And you guys seem to have the that thought process and that vision behind you. So I'm very glad to hear that. I want to shift the conversation a bit. I want to talk about bonds in general. So bonds are generally known to be kind of the safer investment vehicle for a lot of people. Not from like your perspective, you deal with these stuff all day. From a retail perspective, I see on the news, bonds are safer, all of this sort of stuff. I want to talk about some of the disadvantages of using your protocol, if you can be honest with us for a bit. So we know, of course, there's this smart contract risk that comes along with any kind of blockchain transactions. What kind of risks do you think your protocol could have? For example, a liquidity pool that the LPs are providing across chain, they could suffer some kind of exploit and then the funds are gone. Is there any kind of insurance fund for this?
Very good question. We're actually in conversation with one of the largest insurers of smart contracts to kind of, make this their first insurance that they actually do on Solana. You could probably take a guess as to who it is, but you would be able to buy a bond knowing that you will actually get the yield you will get. The LPs will get the yield that they will get. Obviously, insurance provisions being standard, right, as to how it kind of works. But we're definitely doing that. I mean, look, smart contract risk is going to be everywhere, right? Like it's a matter of the quality of it's a given, right? How do you mitigate is really the question, right? You mitigate it by doing an audit. Ours starts in a week and a half. And probably doing more than one audit. You mitigate it by putting out the bounties. You mitigate it by doing insurance, getting insurance. So, these are as much as, these are nuanced attributes of the space, right? The self-custody aspect of it, like that's why it works, right? So yeah, that's definitely, luckily it's a problem everybody has, so we can all collectively solve together, and there are a lot of known solutions for it. And, again, we come out with, as much mitigated as a risk, scenario as possible, because we will have done the audit. We will have the bug bounty live. We will hopefully, can't promise it, but it's looking pretty damn good in terms of getting the insurance out there for people electively if they wanted to cover for it, right? And so all those things will kind of be taken care of. The real risk, right? The real risk is more of a perception risk, right? Historically, if you look at, people born over the last, or not people born, let's say people over the last, if you came to know mainstream finance over the last 14 years, you have always understood interest rates to be next to zero, or, that's basically it. 0 to 3%. Yeah, fundamentally, that's where you think these things are, right? Bonds are valueless, right? That's what we've been taught. That's the mantra of free money, or easy liquidity in global markets. That's what's kind of led us to believe. Well, crypto kind of turns it a little bit different because it gives you a higher yield at times, right? That happens because there's a higher vol and there's a higher convexity, right? If you had $50,000 to invest right now, right, and you said, okay, what do I do? Do I buy a bond that's going to give me 12% interest, or do I go ahead and buy a Bitcoin and change, right? Over 20 years, if current trends stay whatever it is, likely that, Bitcoin is going to do better, right? Over 2 years, the bond might do better. You never know, right? It's one of those weird things that you just really have no idea. But it's about what you seek, right? The Bitcoin could be worth a lot less tomorrow than what this yield will give you in about, in 1 year's time almost, right? So it's about certainty, right? It's about certainty. It's about collateral. Like, collateral is a very important thing for me here, right? Because when you buy a bond here, right, with a high interest rate, and the underwriter and the risk is really in the smart contract, and when we spoke about how that's commonplace for everybody, what's happening is that you're buying an appreciating asset. Now imagine you bought a 6-month bond instead, 15% yield. Now imagine yields were higher, 50%, et cetera, whatever. Imagine 50% yield, right? Well, you go ahead and say it was a 1-year yield, and say you go ahead and you buy you buy one of these bonds, right? And you pay $100,000 in it, so you're going to get $150,000 back at the end of the year. Well, now you can borrow against that, right? You can borrow against $150,000, right? Like, that's huge. That's huge, because you couldn't borrow that much against your Bitcoin that was worth $100,000, or your Ethereum that was worth $100,000. You'd be borrowing $40,000 worth, right? But you could borrow that money. Now you could go buy your Bitcoin and Ethereum because you had a hell of a lot more to invest now than you did before, right? So the point is that I don't want to call it is a risk-free rate that's just not being tapped, right? And if it has a higher terminal value, if cash is worth more later on, then you should not have cash right now, or you should not have as much cash right now. That should be a function of how much more it's worth later on.
And all great points, amazing points. Does that mean, though, that means you have to find a secondary marketplace or someone like a counterparty to allow you to use your NFT as collateral. Are you guys going to be developing this, or is this you're expecting someone else to come and build on top of you?
No, that's a brilliant question. So we have started conversations with people to be like, hey, kind of, you should really use us, because if you use us, your churn will actually go up as more people kind of use our bonds. There is interest in kind of making it collateral on other platforms. That will be key. And kind of, look, people are beginning to use your art NFTs as collateral. You can borrow against that, right?
Yeah.
So there's no reason you can't do it against this. It's a matter of just kind of inking those partnerships. So we're excited about those, and they're part of the pipeline. Our focus is right now very much on the product to make sure that, as intricate and complex it is, that it actually works in its simple form, on the front end, et cetera, all that kind of stuff. There's also, a quick 60-second tangent, right, that I would say is that this is our V1 protocol or V1 product, right? If you look at the white paper, you'll see Superbonds and you'll see Meta Yielder, which is exactly what we've been speaking about for the past 50 minutes, 40 minutes, 45. And then the other one is called Meta Lend, right? Meta Lend is a very, very exciting thing for us, because what we've done in Meta Yielder is we basically said, when you buy a bond, the cash doesn't leave the ecosystem. You're always one for one in that, it's not as if somebody sold a bond, you bought that bond and they took the cash away. They may never come back, right? You never know about that, right? But in this particular case, we monitor it. We keep it on chain within the ecosystem, crypto ecosystem, to generate yield, right? But in Meta Lend, what we are saying is, look, the ecosystem as a whole in crypto is coming to a point where people are starting to organize themselves into DAOs, tribes, whatever it is, right? The incidences of foul play by bad actors is naturally going to reduce, right? What do I mean by that? Okay, if an individual wants to come and borrow money and issue a bond, right? And you say, yeah, I'll give you some money, right? He may disappear. You'll never see that money again, go through some tumblers, whatever it is, right? You're done. You're gone. You're not getting your money back, right? But now imagine DAO, right? And they say, hey, look, we've been around for 2 years. We've got $50 million of capital, and we've got 400 unique people that are voting on this process, right? We need to borrow $2 million. Well, they could go to your standard protocols and they could borrow 40% again, right, of whatever they post, or they could come to this platform, MetaLend, Superbonds platform, right, and say, guys, we need to raise $2 million. Here's the interest rate we're going to pay. Here's the installments or coupons that we're going to pay, and here's some extra bonuses we may throw in. Do you want to fund us? Maybe people do, maybe people don't. Maybe they get their money, maybe they don't. Maybe they get their money and they don't pay back, right? But what I'm saying is, all those questions, if you think about the answers to that, what is 65% under the curve going to be, or 75% under the curve going to be? It's going to be that you're going to have a good outcome, right? We're not talking about edge cases here. And that's how you kind of push use case forward, right? Where you see enough of an audience to kind of tap into it, right? Because what they're going to do, if the DAO doesn't pay back or doesn't do it properly, they're going to kill their own credit history, right? And there are people building credit scores, et cetera, so forth. We get it, right? There's plug and play options available for that. But the point is that if you issue a bond and you don't pay, well, you have a bad history, right? Yep. And you've shot yourself in the foot. And this is not what you were built for as a $50 million DAO, right? You can't go buy your golf course now that you raised all this money for. So that, we think, is now going to be the next chapter of borrow lend. We have saturated the market of traditional borrow lend in the way crypto has kind of structured it, and a few really smart guys pioneered it, right? And we think this is the new way forward. So we're very excited about that. We've started building on that product already. We see the first iteration coming out late Q2. We're quite excited, and obviously there are a lot of natural candidates that will be, looking to kind of issue. So that'll be quite cool. We'll be kind of looking to facilitate that. And I would say that, it will start the credit market off, right? Because, once you buy those bonds, they'll be tradable. In this particular instance with Meta Yield, they're redeemable, right? Against the smart contract right away. Those you can trade, just like you could trade any sort of art NFT. Hey, I think it's worth this. Hey, I think it's worth that. I don't think they'll pay. I think they'll pay. Whatever it is, you got a good deal in terms of yield. And it starts off a real bond market. I digress because I thought that was quite important to kind of show the dichotomy between the two, but both still very much talking about yield, issuance, an eventual, kind of being made whole on whatever it is that you hold. So yeah, very excited about all those things.
Dude, I'm super hyped. I want you to go to mainnet so I can use this protocol and earn some really good safe yield for myself. It's just
awesome. Well,
like the way you're explaining it and the way that like it comes across. I'm like, yes, why don't we have this? Like, this is what happens in real life at the moment, where these people are able to utilize, rich people are able to utilize all of these tools at their advantage. But now we're trying to get a taste of it and trying to reinvent it, make it better on the blockchain. So I just personally, thank you. So we're heading to that 50-minute mark, maybe 1 hour mark. We'll see if we can field any questions from the stage. We've got 41 people live at the moment. So if you do have any questions, please go ahead and type in the live questions channel. Now we've got one already from Alex ARB. We'll take 2 or 3 questions and then we'll start thinking about closing it up if that's okay. So how do you compare to the competitors? Do your current competitors, the only thing I actually know for fixed rate and kind of NFTs are the future finance, where you could get, I think it was $100 NFT, and then it kept constantly paying you USDC into your wallet. This is totally different from what you guys are doing. How do you see your competitors in the space? Are there any coming close to you at the moment?
No, we don't. We don't really see any competitors. I know that there are some guys that are trying to build yield into a stable coin and do all kinds of stuff. But in terms of fixed financial, fixed rate financial NFT, continuous issuance, not limited by amount, and the ability to freely transfer, use as collateral, do all kinds of things.
Sorry, lost you there. Repeat your last sentence, please.
In full humility, we don't really.
Oh no.
Can you hear me?
Yes.
Yeah, sorry. What I was saying is, in all humility, we don't see any competitor for us right now.
Right, fair. I don't see anyone either. Like we do see some weird niche cases with Port Finance doing fixed rate tokens, but nothing to the scale and to the vision that you guys are trying to do at the moment, and not with your backing anyway, not with your financial and like derivative backing. My God. Any other questions from you guys in the live stage here? Same person here. Does this network provide any additional benefits for verified NFTB artists? I'm not too sure what the NFTB artists are. LXB, is this familiar to you, Vishal?
Unfortunately, it's not. No.
That's all good. No problems. So you don't currently have any competitors. Your token's out there on Solana at the moment. Is there any specific topics you want to touch on before we start thinking about closing out?
Well, I'm happy to take any more questions. I don't want to kind of inundate with a lot more information. You'll be able to see all that. You'll be able to read a lot of the information. Look, our code is not going to be fully public. I think that's important for everybody to realize. But it's going to be audited, so that there's no reason, you shouldn't have confidence in it. We've realized that, originally the idea was to go open source, and then there's, eventually there's enough devs now waiting to kind of see anything cool come down the pipeline and just like slap their own, UI on it and UX on it. And put some more marketing dollars behind it, right? So we are, we're just kind of heads down, building product, looking to ship it, and ship it soon. That's basically all I want to say.
Yeah, right on, man. Now, I've got 2 last questions for you. So let's say your mainnet launches, all goes well, your audits are going well, you've got TBL, total bonds locked, over $100 million, going to that $500 million mark. We've got some institutional investors on board. It's all going great. What's Superbonds going to be looking like in 5 years? What's your giant end goal vision?
Yeah, so look, we want this to be the place where yields are tapped in general, right? We're laying the plumbing to go cross chain such that you don't need to go elsewhere. That's the whole idea, at least for fixed yield, right? We should be able to get it all for you on this one platform. And then with that issuance as well, if somebody's looking to raise capital and they are an entity, they really should be, we want to make sure we're relevant to them, that we're, a first port of call for them as well. That's the idea. That said, you asked 5 years out. This entire platform is going to be a multi-sig back to the community, right? We'll retain a seat, or we'll retain some part of it to make sure it's functioning correctly, et cetera, so forth. But this is going to be a community-run thing, because that's the whole spirit of things, right? Or we would have done this in a centralized fashion. Why not just raise equity and do a centralized company and do all this kind of stuff? No, the idea, the thought process behind this whole thing is that we stay true to it. We stay transparent, on chain, fully auditable, and eventually give it back. Right, that's the whole idea. So wherever the community wants to take it, it can take it. Right, the governance mechanism isn't yet determined. It's hard to think how it's not going to be somehow involved with SB, but we don't know yet. When it is ready, it will be kind of put back to everyone.
Right. So you're going for the full decentralized governance play, maybe with or without SB token.
Yeah, I mean, look, the SB token will always be relevant. Well, what I kind of meant to say was, does the SB token confer, get you anything special with regards to how governance works?
Yep, right. And my last question for you, mate, is we'll think about wrapping up here. I don't see any other questions. His advice for first comers. What is his recommendation? Globo, not too sure what you mean there, but we'll move on with the last question I have here before we close it off. So, Vishal, I want to say thank you very much for coming on stage.
Thank you for having me. Yep.
No problems, mate. This is the general question we get everyone to answer here over at Grape with myself. What general advice would you give to someone who's either starting out in crypto, or what general advice would you give to anyone at all? My advice right now is don't look at the market. It's really red. Close the computer, go out for a walk, think about investing in bonds, and come back in 30 to 90 days and have some nice rewards waiting for you. What advice would you give to someone?
Yeah, I would definitely echo the second part of it. I would say, look, this space is full of a lot of noise, right? That means from investment opportunity to people talking and hyping up projects to...
Lost ya.
It's very hard to stay on top of anything and everything that is happening in this space, right? FOMO is a natural byproduct of actually being in this space, because you're not going to be able to get to everything, full stop, right? And then when the opportunity comes at times, if you find, we've always said to ourselves, we just go with our gut, right? I'd rather get something wrong and have, that been what my gut says than kind of missed out on something because I didn't listen to my gut, right? And to not confuse that, that gut with the fear, like, oh, it's red, it's doing this, oh, it's small, we don't know anything. So it's just one of those things where, if you've got a natural instinct about something, go for it, right? And I think that's how those that have performed really well in this space have done it. It is highly instinctive. Everything else kind of falls to the wayside, and it's just administrative stuff.
It's very similar to some of the other feedback kind of advice we've gotten from other Solana devs that very similar to what you're saying. Build quickly. If you got a good feeling about it, ship it, and then reiterate it at administration later on and do all this sort of stuff around it later. But just like you're saying, if you got a good feeling, do it. If you can build it, do it, which is what you guys are doing at the moment. So that's about it, guys. We will look at ending the interview here. There's all the links in the live questions chat for you to have a look at these guys. Have a look at their DevNet. Go ahead and try it. This is a very unique product that is being offered to Solana at the moment. And I see a lot of good things happening with these guys. If you're on YouTube, thank you very much for watching. I'm going to leave the links to all you need down in the description down below. Thank you very much for watching. Vishal, I want to say thank you very much again for joining us, mate.
Thank you so much. Thanks, everybody. Really appreciate it.
All good, guys. So that's about it. I will end it here. Ciao. Bye.